I would just sort of take issue with a point that Nicole just put forth, as did Rick, that I don't know that there's an immediacy in terms of the need to cut rates. I don't see why. I mean, Rick did say by the middle of the year they could be cutting, and I think that's a reasonable position, that the economy will have evolved and the path of inflation will have evolved to a degree such that they could probably begin actually, or at least contemplating, cutting rates by the middle of the year. But before that seems unnecessary to me. I'm not particularly concerned. The economy is doing just fine right now. And I don't know that there's any immediate need to reduce the level of interest rates.
But do you agree broadly with him that the Fed is actually going to pull this off? That, I mean, he made it clear that, I don't know about landings and things like that, implying that we may have no landing. I mean, maybe we just this economy keeps humming along good enough and inflation comes down enough that we're like, holy smokes, they actually did it.
Yeah, listen, that's always been a possibility, and certainly the odds of it today are higher than they were, call it 6 or 9 months ago. I would just remind viewers a point that a lot of people have been making, myself as well, that it always looks like a soft landing before a hard landing. And so on the one hand, yes, inflation has come down tremendously. No, we have not had any meaningfully adverse effects in terms of the labor market, which is ultimately how you would define a soft to hard or no landing. But at the same time, history is quite clear that the Fed usually doesn't get this right. And while it does appear that they are getting it right for now, the odds still do exist that perhaps those lagged effects are going to start showing up somewhere around the first or second quarter of next year.
So then what do I want to do, Nicole, if you agree with Rieder that there's reason to be reasonably positive on the market next year? I mean, he said high single, low double-digit returns in equities. How's that sound to you?
Yeah, I mean, the setup in 2023 has made 2024 look more advantageous. And so while we've harped on the Magnificent Seven, it's really left runway to say there is opportunity for share price to catch up to the likeliness that we saw troughs in earnings, and we haven't really seen performance of companies catch up to that share price. And so when we think about sectors, we can think about the fact that supply will likely continue to be cut in energy. So there's kind of this window of opportunity there. We can look at healthcare and the performance year to date. We can think about the infrastructure spending and bills around that, and then look towards mid cap. And we don't necessarily have to make a determination about whether we're late cycle or early cycle. Instead, we can say, where's the money flowing? And I know that industrials make up 20% of the mid cap space. And so there might be more stickiness there, regardless of knowing perfectly where we are in the cycle, which isn't textbook definition of when you deploy money into small or mid cap. So I think there's just a lot of opportunity for investors. And while Rick spoke specifically to pensions, endowments, sovereign wealth funds, I think from our side of the business, working with individuals and family wealth, there's never been a better time to actually create portfolio construction based on whatever the timeline is for next year. And to quote Rick again, you can clip a lot of income in a lot of different pockets across the market spectrum.
So on that note, then, Dan, working for Solus Alternative Asset Management, what does 60-30-10 look like to you if it's 60 equities, 30 high quality yielding assets, and then 10 private credit and things like that?
Yeah, we've talked about this in the past. You're entering the year with high yield yielding, call it 8.5%. IG somewhere in the 5 to 6% range. Loans will get you a little bit more than that. And then Rick mentioned MBS. If you're going to start cutting interest rates, then the level of spreads, the basis in the MBS market could be attractive as well. A lot of this may be out of the reach for a lot of individual investors, but you can certainly put together a attractive portfolio along the efficient frontier, to borrow a phrase no one's going to know, that's going to give you pretty attractive risk-adjusted returns next year. And to the extent that you don't have a recession, and I don't think that it looks like you're going to, at least for the next few months, let's say through the middle of the year, you layer on top your equity exposure on top of that, and you're going to have a pretty decent year. Again, for the stock market, we're going out here in the 4,600 or something range. I don't know why 5,000, 5,100, if you don't have a recession, isn't your base case scenario.
The other thing, I mean, let's be honest, the individual investors who may have felt the very way that you said, being on the outside with their faces pressed up against the glass when it comes to alternatives, now actually have platforms by which registered investment advisors, and we've highlighted some of those throughout this year, have given them access, the likes of which they've never had before. That's point one. Point two, Nicole, if I turn to you and we react to another thing that Rick Rieder said, and as it relates to equities, let's spin back there.
Yeah.
Healthcare, energy. What about underperforming spaces moving into 2024?
Yeah, and I think Rick, brought forward at the end of your conversation the fact that the Fed does have some control over the short end of the curve that makes the debt service cheaper, and where we often leave out the part of the conversation around growth being an offset to deficit. And so when we talk about those pockets, all of which you just mentioned, Scott, a lot of them are going to be affected by the next leg of the digitization of technology and infrastructure within business. And so we go a lot back to this productivity boom, the space for it, and where that drives the market. And then suddenly, this 2024, 2025 outlook of 10% earnings growth looks like a possibility. And that is where I don't think investors should give up on, buying the 493, expanding into the small and mid cap, which we've still seen outflows out of. And then, technology is still a meaningful component, these mega tech names. But again, to your point, there is so much available to the investor now. And I think this is a time to just really position yourself going into the end of the year.